The money didn't disappear overnight. It was still there, in your account, on paper, in numbers on a screen. But one morning, it simply bought less. Not because you spent it, not because you were careless, but because someone, somewhere, decided to create more of it. That's the uncomfortable truth about printing too much money. Nothing explodes at first. No alarms, no sirens, just a slow, quiet change in what money means. And right now, this matters more than ever, because nearly every major economy has been creating money at a scale that would have sounded absurd a decade ago. Trillions created in years, sometimes months, sometimes weeks, all justified as necessary, temporary, under control. So what actually happens when a country prints too much money? Not the slogan version, not the panic version, the real sequence of events. Let's strip this down. First, a simple but crucial clarification. Modern countries don't literally run printing presses day and night. Most new money is created digitally, with keystrokes. Bank reserves expanded, government bonds purchased, credit injected into the system. It feels abstract, but the effects are very real. Usually, this process starts during stress, a recession, a war, a pandemic, a financial crisis. Something breaks, markets freeze, jobs vanish, fear spreads faster than facts. Governments step in and say the same thing every time. We need liquidity, which is a polite way of saying we need more money in the system now. Central banks comply. They buy government debt. They lower interest rates. They flood banks with cash. At first, it looks like a rescue. Markets calm down. Asset prices stop falling. Headlines talk about recovery. This is where the story usually ends in simple explanations. Money printed, crisis avoided, problem solved. But that's only the first chapter. Because printing money doesn't add new goods, new services, or new productivity. It adds claims on existing things. More tickets chasing the same number of seats. In the early phase, this doesn't show up in grocery prices. It shows up somewhere else. Asset markets. Stocks rise, real estate climbs, crypto surges. Anything that can absorb excess money does. People confuse this with growth. It feels like wealth is being created. But what's really happening is repricing. Money is becoming less scarce. Assets respond first. This is why money printing often looks harmless at the beginning, even helpful, especially if you own assets. The danger starts later, because new money does not enter the economy evenly. It enters through specific doors: governments, banks, large institutions, financial markets. The people closest to those doors feel the benefits early, before prices adjust. Everyone else gets the money later, after prices have already moved. This delay is not accidental, it's structural. By the time money reaches wages, pensions, and fixed incomes, the system has already adapted. Rent is higher, food costs more, energy prices have shifted. So while the total amount of money increased, purchasing power didn't increase equally. This is the first hidden effect of printing too much money. It redistributes wealth without a vote. Now comes the part people misunderstand. Inflation is not just prices going up, it's the unit of measurement breaking. When a country prints too much money, each unit carries less information, less trust, less weight. This creates a feedback loop. People notice prices rising. They expect more inflation, so they change behavior. They spend faster. They save less. They rush into assets. They borrow if they can. Why hold something that loses value over time? This behavior pushes prices up even more, not because of greed, but because rational people adapt. Policymakers usually react late, they always do. When inflation becomes visible enough to worry voters, it's already embedded, so central banks raise interest rates aggressively. This is where the damage spreads. Higher rates slow borrowing, businesses cut expansion, Hagezing freezes, layoffs follow. The same people who benefited least from money printing feel the slowdown first, again. Meanwhile, governments quietly benefit from inflation because they are the largest debtors on earth. When you print money and cause inflation, the real value of existing debt shrinks. You still owe the same amount on paper, but you repay it with cheaper money. This is why excessive money printing is tempting. It feels like a solution that doesn't require explicit pain. No tax votes, no spending cuts, but the bill is always paid, just indirectly. If money printing continues long enough, trust erodes, not dramatically at first, then suddenly. People start pricing goods in something else, foreign currencies, hard assets, anything stable. Capital leaves, the currency weakens, imports become expensive. At extreme levels, this becomes a currency crisis. History is full of them, not just in failed states, but in countries that once seemed stable. And here's the irony. Printing money is often done to protect stability, but overuse creates fragility. It distorts price signals, encourages debt over productivity, rewards proximity to money creation instead of value creation. The system becomes louder, more volatile, more dependent on constant intervention. By the end, money still exists, banks still function, markets still trade, but the social contract around money changes. People stop trusting it as a store of value, only as something to get rid of quickly. So what really happens when a country prints too much money? Not instant collapse, not immediate chaos. First, relief, then distortion, then redistribution, then loss of trust. And the most important part is this: there is no clear line where enough becomes too much, only hindsight. Every country believes it will stop in time, that it's different, that it's controlled, until the consequences are already baked in. So the real question isn't whether money printing works in the short term. It often does. The real question is, how much trust can a currency lose before people notice? And what happens when they do?